Hi everyone, welcome back to our Week 1 live chat for Finance 4443, Financial Policy and Strategy. I'm Dr. Mark Dennis, and in this second part of our Week 1 live chat, we'll be diving deeper into two key areas of corporate finance: bond valuation and stock valuation. Chapter 6 from your reading focuses on bonds, a form of long-term debt used by corporations and governments to raise capital. When you invest in a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and repayment of the principal at maturity. We'll cover key bond features like coupon rates, maturity dates, and yields, along with how to calculate their present value. Bonds are critical to understanding corporate capital structures and portfolio strategy. They're also incredibly relevant in today's rising interest rate environment, where fixed income investors are paying close attention to inflation and Fed policy. Estimating the value of any investment connects directly back to a fundamental concept from earlier in the course, the time value of money, or TVM. The core idea is that money today is worth more than the same amount in the future due to its earning potential. When we value any asset, whether it be a bond, a stock, or even a corporate project, we do so by calculating the present value of its future cash flows. This means discounting each expected payment back to today using a rate that reflects both time and risk. Here we see a generic timeline showing how we apply the time value of money to value future cash flows. Each cash flow is discounted back using the required rate of return, depicted by the lowercase letter r. This model is the basis for valuing any asset, and not just bonds. You'll see similar cash flow timelines in capital budgeting and equity valuations later in the term. Consider this example. Suppose you are evaluating a small rental property that produces $10,000 in net income annually. If your required return is 8%, you would discount each of those cash flows at 8% to determine what the property is worth to you today. This kind of valuation is exactly how investment bankers and analysts decide what to pay for assets in mergers, acquisitions, and capital markets. Now let's focus specifically on bonds. The basic bond structure includes the face value, also known as the par value, which is typically $1,000. This is the amount paid back at maturity. Coupon payment. This is the interest payment made to the bondholder, usually on a semi-annual basis. Maturity. The length of time until the bond's principal is repaid. For example, if you own a 10-year bond with a 6% coupon and a $1,000 face value, you would receive $60 per year, or more specifically $30 every 6 months, until the bond matures, at which time you would receive back the face value of $1,000 as well. Bond valuation is about adding up the present value of all of those future payments, including both the periodic interest and the lump sum repayment at the end. The discount rate used is the bond's required rate of return, often based on market interest rates and issuer risk. Now that we've covered the concept, let's break down the bond valuation model visually. You'll notice that bond cash flows typically come in two parts. First, there are periodic payments. And then there is the lump sum principal repayment at maturity. The periodic payments or coupon payments, we use the letters P and T. And for the repayment at maturity of the principal, we use FV or future value. The bond's value today is simply the present value of all the future interest payments plus the present value of the maturity amount using the bond's required rate of return. And we use that required rate of return as a discount rate. Suppose you are considering a 10-year bond that pays $50 every 6 months and then returns $1,000 at the end. If market rates go up, the present value of those payments goes down, meaning the bond price drops. This inverse relationship between bond prices and interest rates is a foundational concept in finance. What you are seeing here is the present value formula that breaks a bond into its two cash flow components: the present value of all of the coupon payments and the present value of the lump sum face value, also known as the maturity value, typically $1,000 per bond. We express this as the formula you see on the screen, where INT equals the annual coupon payment in dollars, R sub D is the discount rate or required rate of return, N equals the number of periods until maturity, and M equals the maturity value of the bond. Again, typically the face value of $1,000. Let's walk through what each part does. The first term is the present value of an annuity. This represents the stream of coupon payments that the bondholder will receive over time. The second term is the present value of a lump sum, the repayment of the face value when the bond matures. This formula is useful because it shows us why bond prices fluctuate. When R sub D, the market rate, goes up, the present values of both the coupon payments and the maturity value go down, thus lowering the price of the bond. The opposite is true when interest rates fall. Here we apply the valuation model to a real example. Genesco has issued a 10% coupon, 15-year, $1,000 face value bond. This means the investor receives $100 every year in interest for 15 years, followed by the $1,000 that is paid back at maturity. If the required rate of return is also 10%, the bond will be priced at par, or $1,000. Why? Because the return you require matches what the bond is paying. But let's think about what would happen if market rates jumped up to 12%. Now the bond's fixed 10% coupon becomes less attractive. Investors would demand a lower price to achieve a 12% yield. This is how discount pricing works. Conversely, if rates dropped to 8%, the bond price would rise. This is premium pricing in action. When using a financial calculator, we plug in the following values using these variables. N equals 15, the number of years of compounding. I over Y, or just I for short, is 10, that is the required rate of return. Payment equals 100, which is 10% of 1,000, and future value is 1,000. When you calculate the present value, you get the figure of $1,000, which aligns with what we would expect because the coupon rate matches the required return, and this bond is priced exactly at par value. Most bonds do not pay interest only once a year. They pay semi-annually, every 6 months. This means the bondholder receives 2 payments per year, which changes the math. Notice that all of the variables, except for the future value, must be divided by 2. Let's value a Genesco 8% 14-year bond under semi-annual compounding. In this case, the number of compounding periods is not 14, but instead is 28. Likewise, the coupon payment, since it is made every 6 months, is not $100, but instead is $50. The interest rate must also be divided by 2, going from 8% to 4, but the face value, or future value in this case, always remains constant at $1,000. If you were to use a calculator or spreadsheet, you would find the present value is equal to $1,166.63. This bond trades at a premium because its 8% coupon is higher than the return you would get if you were to buy a newly issued bond at a lower market rate of 6% or 7%. Next, let's discuss yield to maturity, or YTM. This is one of the most important bond metrics you will ever use. Yield to maturity is the average annual rate of return a bondholder would earn if they bought the bond today and held it until it matures, assuming all interest payments are reinvested at the same rate. This reflects not only the coupon payments, but also any gain or loss realized depending on whether the bond is purchased at a discount or a premium. This is crucial for bond investors because it lets them compare apples to apples, even across bonds with different coupons, prices, and maturities. Always remember that bond prices and bond yields move in opposite directions. When yields rise, prices fall, and vice versa. This helps explain why bond mutual funds often lose value when interest rates rise. Let's take this a step further and calculate yield to maturity for a bond offered below its par value. Suppose you were offered a 10-year, 8% coupon bond with a $1,000 face value, but it is priced at only $875. The coupon is paid semi-annually, so that means you will receive $40 every 6 months, which is the 8% annual coupon divided by 2. Here's what's going on. You are investing $875. You are receiving $40 every 6 months for 20 periods. That's 10 years times 2. And eventually you collect the $1,000 face value back when the bond matures. Your job is to calculate what rate of return would make sense. Let me rephrase that. Your job is to calculate what rate of return would make those future payments worth $875 today. That is your yield to maturity. This problem is perfect for a financial calculator or an Excel spreadsheet, and it shows something important. When a bond sells for less than par value, the yield to maturity is higher than the coupon rate. Why is this? It's because you're buying the bond at a discount, and you will gain not only from the coupon payments, but also from the price appreciation when it matures. Try this on your own using the financial calculator of your choice or an Excel spreadsheet, and input the variables that you see on the slide. So now we get to see the mathematical structure behind yield to maturity. If you are a numbers person, this slide is for you. Yield to maturity is the internal rate of return, that's the IRR, on the bond. This is the discount rate that makes the present value of the bond's cash flows equal to its current market price. In other words, it is the return you would earn if you bought the bond today at the given price and held it until maturity. Take a look at the first line of the equation shown here. This shows how each semi-annual coupon payment of $40 and the final lump sum of $1,000 is discounted back using half the annual required rate of return, because this bond pays semi-annually. Now in the second line, we plug in the bond's actual market price of $875 and we solve for yield to maturity. That's the I, or I over Y variable. This is what you're doing when you use your financial calculator or Excel to solve for the discount rate. You're basically asking this question: what rate of return makes all of these cash flows add up to $875? Here's the catch. You can't solve this equation algebraically. You have to use trial and error or a financial calculator to do it numerically, which is exactly why tools like financial calculators and Excel's rate function exist. And remember, yield to maturity is quoted as an annual rate, so once you solve for the semi-annual yield, you must multiply it by 2 to get the annualized yield to maturity. Next, we shift gears from debt instruments to equity, specifically common stock, and how we determine its value. Let's break down the key terms you will need to understand before we jump into stock valuation formulas. These symbols are foundational, and you will see them used repeatedly across different models. D sub T is the dividend expected to be paid at the end of year T, whatever year that is. So D sub 1 is the dividend expected at the end of year 1, D sub 2 at the end of year 2, and so on. P sub T is the expected price of the stock at the end of a particular year. Just like D sub T, it is a forward-looking estimate of what the stock might be worth in the future. P sub 0 is the current price of the stock today, what you would pay to buy it in the open market. G is the expected growth rate in dividends, often assumed to be constant in simpler models like the Gordon growth model. R sub S is the required rate of return on the stock. This is a critical number. It reflects the minimum return investors demand for taking on the risk of owning the stock based on opportunity cost, risk, inflation, and so forth. Think of it like this. If you buy a stock, you're buying it because you believe the expected return, the dividends plus the appreciation over time, will meet or exceed your required return. Let's say your required return, your R sub S, is 10%. If you think the stock will return only 7%, it's not worth it. But if you estimate a 12% return, that is a green light, at least from a valuation standpoint. You'll soon see how all of these variables come together to estimate what is referred to as the intrinsic value of a stock and determine whether it is a good investment. Now let's add a couple more terms to our toolkit. Terms that break down where your return from owning a stock actually comes from. When you invest in a stock, your total return has two primary components. Dividend yield, which is the income portion of your return, and it's calculated as the expected dividend over the current stock price. You see the formula here as D sub 1 over P sub 0. For example, if the expected dividend is $2 and the current stock price is $40, then the dividend yield is 5%. This tells you how much cash flow you're receiving each year as a percentage of what you paid for the stock. Capital gains yield. This is the growth portion of your return. It reflects the expected appreciation in the stock's price. If you expect the stock to increase in value from $40 to $44 over the next year, that's a 10% capital gain. Together, these form your total expected return when you add them together. These terms are important because not all stocks generate returns in the same way. This is where we tie it all together. Once we've calculated a stock's expected rate of return, that's the R with the little rooftop over it, we need to compare it to the required rate of return, or R sub S, to make an investment decision. If the expected return is greater than or equal to the required return, then we say the stock is fairly priced or even undervalued, and it may be a good investment. If the expected return is less than the required return, then the stock is overpriced and it's probably not a good investment, at least not right now, based on these fundamentals. Here we begin visualizing how stock valuation works using a cash flow timeline, much like we did with bonds. The key difference here is that stock cash flows, dividends, can extend indefinitely. There is no maturity date. Let's walk through what happens on this timeline. At time 0, that represents today, when you buy the stock and you pay the current price. Then, starting in year 1 and continuing indefinitely, the company is expected to pay a stream of dividends, D sub 1, D sub 2, D sub 3, and so on. Unlike bonds, there is no maturity date. Stocks represent an ongoing and potentially infinite claim on the company's profits. Because this stream of dividends can theoretically continue forever, we model stocks using infinite series, especially when assuming a constant growth rate in dividends. This is where the dividend discount model comes in, abbreviated DDM. The model assumes that the stock's intrinsic value is equal to the present value of all expected future dividends. If that sounds a little abstract, think of it like this. You're buying the right to receive a perpetual stream of income in the form of dividends. Your job is to figure out what that stream is worth to you today based on your required rate of return. We'll soon take a look at the constant growth version of this model, which simplifies the math substantially. But this timeline gives you a conceptual starting point. Stock value is based on expected future cash flows discounted back to today. That point is worth repeating. Stock value is based on expected future cash flows discounted back to today. This is where we take the timeline we saw on the previous slide and express it mathematically using the dividend discount model. At the top of the formula, you see a long series of expected dividend payments, D sub 1 through D sub infinity. This is simply the present value of each expected dividend, one period at a time, discounted using the investor's required rate of return, R sub S. The hat notation over D means we're working with expected values, not actuals. Now look at the bottom of the slide. This formula is the shorthand version. The sigma notation just tells us we're summing up an infinite stream of dividends discounted back to today. And since stocks have no maturity date, the cash flow stream is theoretically infinite. So here's the challenge. Unless dividends follow a specific pattern, like constant growth, this version of the formula is not easy to compute by hand. This is why we often simplify this using assumptions about dividend growth, which leads us to the constant growth model we will discuss momentarily. But this version, this infinite sum, is the foundation of stock valuation theory. This is why we say the value of a stock is the present value of all expected future dividends. Do keep in mind this model does not work well for companies that do not pay dividends or those with erratic dividend policies. However, for the mature dividend paying firms, it is one of the best tools that we have. Let's simplify things by making a realistic and practical assumption that dividends will grow at a constant rate over time. This is the idea behind the Gordon growth model, also known as the constant growth dividend discount model. Here we assume that company dividends will increase at a steady and predictable rate, one that mirrors long-term economic growth. This is often a reasonable assumption for more mature companies like utilities, telecoms, or large-cap consumer brands. So what do we mean by constant growth? It's growth that doesn't spike or collapse, but rather continues at a stable pace year after year. This rate is represented by the variable g, and it must be stated as a decimal. So a 5% growth rate would be entered as 0.05 in the formula. This assumption dramatically simplifies our valuation formula. Instead of discounting an infinite series of future dividends, we now use a neat little expression: P sub 0, the current price, equals the current dividend divided by the difference between the required rate of return and the growth rate. Keep in mind that this model would not work well for companies that don't pay dividends or which have highly variable earnings, or happen to be in fast growth or startup stages. But for steady firms, this model works quite well. Notice the values for the variables given at the top of this slide. This is a visual representation of everything we have been building towards in the constant growth model. It shows us two things. First, the growing stream of future dividends, that would be the blue dashed line, and the present value of each of those future dividends, which is the red stepped area beneath it. Let's unpack what's going on here. We start with a present dividend of $1.60, the dividend most recently paid. If that dividend grows at a rate of 5%, then the next year's dividend, D sub 1, is going to be that number multiplied times 1.05 to give us $1.68. What we really care about, though, is what are these dividends worth today in today's dollars if we were to discount them back to present value. We do this using the required rate of return, in this instance 20%, and we compute the present value of each dividend using the formula in the center of the slide. This gives us the red staircase pattern, the one that's going downstairs. Every future dividend gets smaller and smaller in present value terms because we're discounting it further and further into the future. Notice the red shaded area under the curve. That is the total present value of the infinite dividend stream, and it sums to about $11.20. So this is a great way to illustrate that stocks are indeed worth the sum of all discounted future dividends, even if there are an infinite number of them. It helps us understand why dividends far in the future are worth much less today, and also why most of a stock's present value comes from dividends in the near to medium term. Additionally, it shows why a small change in the required rate of return or in the growth rate can have a huge impact on the stock's valuation. This is a graphical reminder that even with infinite cash flows, we can simplify valuation into a manageable expression, provided we make good assumptions. This slide brings us full circle in our valuation model. Now that we know how to estimate a stock's intrinsic value, we can flip the script and ask this question. If I buy a stock at today's price, what return should I expect to earn? The formula on this slide answers that question, where R sub S is your expected rate of return, D sub 1 over P sub 0 is the expected dividend yield, the income component, and G is the expected capital gains yield, which reflects how much the stock price is expected to grow over time. So let's break that down and keep in mind variables with a rooftop over them are expected values. The dividend yield tells you how much cash income you're getting for each dollar you invest. The growth rate, G, tells you how much you expect the stock's price to rise over time. Together, they make up your total expected return from owning the stock. You'll see an example using actual numbers at the bottom of the slide to illustrate this further. Thanks for sticking with me through this second part of our Week 1 live chat. We covered a lot of ground here, from the time value of bond cash flows to the valuation of stocks under constant growth assumptions. As you reflect on these concepts, remember, valuation is as much about assumptions and expectations as it is about formulas. Whether it's a bond trading below par value or a stock priced for perfection, the tools we've reviewed help us connect the math to actual market behavior and ultimately to smarter financial decisions. As always, if you have any questions about this content or want to go deeper on any topic, I encourage you to do some rational and additional research on your own. After you do that, feel free to email me or give me a call to discuss what you found. I'm always happy to clarify or to chat one-on-one. As always, try not to overthink things too much. Just like Rodin's thinker here, sometimes you need to pause, process, reflect, and then proceed. Thanks again, and I'll see you in the next session.